Your entire savings account can vanish in 90 seconds if you trade penny stocks without spotting the manipulation. Last Tuesday, a single coordinated pump operation wiped out 20,000 retail accounts before the market even hit lunch. It starts with a quiet afternoon at your desk where a flickering ticker symbol promises a quick fortune, but behind that chart, an invisible algorithm is already waiting to trigger your liquidation. Your desk, and you just found a stock trading for pennies that claims it has the next big technological breakthrough. It looks like your ticket to financial freedom. Grab a glass of water, get comfortable, and let us look at the reality behind these charts. The first thing you need to understand is the sheer scale of the manipulation inherent in the microcap market. A penny stock is defined as any security trading for less than $5 a share, but the ones most people fall for are the true sub-dollar stocks. These companies often have no real revenue, no viable product, and no clear path to profitability. Consider the classic pump and dump scheme. You might think this belongs in a movie, but it happens every single day in the dark corners of the over the counter markets. A group of promoters buys up a massive position in a dormant, worthless shell company. Then they launch a coordinated marketing campaign using spam emails, social media bots, and fake investment newsletters. They create a sense of artificial urgency, claiming that the company is about to sign a multi-million-dollar contract. Investors like you see the price creeping up on their screen and fear missing out. You buy in at 20 cents, then 30, then 40. The volume is surging, the hype is reaching a fever pitch, and you are feeling like a genius. But as soon as the price hits your target, the insiders dump their millions of shares all at once. The price crashes to 5 cents in minutes. Your account balance is gone before you can even hit the sell button. That is the easy win for the scammers, but a complete loss for the person trying to build real wealth. Now, let us level up our understanding of how these companies stay afloat. Even if you avoid a clear scam, you are still fighting against the math of toxic financing. Many of these companies rely on what are known as convertible debentures. Think of it this way: the company needs cash to keep the lights on, so they borrow it from a private lender. Instead of paying back the loan with interest, the company gives the lender the right to convert that debt into new shares of stock at a massive discount. Let us say the stock is trading at 10 cents. The lender converts their debt into shares at a fixed rate of perhaps 5 cents. They immediately sell those shares into the open market at the market price of 10 cents, effectively doubling their money overnight. Every time they do this, they dilute the existing shareholders. Your stake in the company shrinks because there are suddenly millions more shares in existence than there were the day before. You are holding a piece of a pie that is being sliced into thinner and thinner shards. By the time you notice the downward trend in the price, it is already too late. This is where things get interesting for the average investor. If you have found this breakdown helpful so far, hitting that subscribe button helps me keep bringing you these deep dives into how markets actually function. I want you to stick around because what comes next is the most important part of the puzzle. All right, let us talk about the third method, the one that makes penny stocks a losing game even when they are not being actively manipulated or diluted. This is the problem of liquidity. When you buy a share of a blue chip company like Microsoft or Apple, you can sell it instantly at a market price that is almost exactly what you see on your screen. There are millions of buyers and sellers at any given moment. Penny stocks are different. Often, there is nobody on the other side of the trade when you finally decide you want out. The bid ask spread is the gap between what a buyer is willing to pay and what a seller is asking for. In a normal stock, this spread might be 1 cent. In a penny stock, the spread can be massive, sometimes 10, 20, or even 50% of the stock's total value. You buy at 10 cents thinking you are doing well, but you realize that the best buyer is only willing to pay 8 cents. You are down 20% the second you execute the trade. Data from the SEC or Securities and Exchange Commission, based on an analysis of over the counter market activity, consistently shows that the survival rate for small microcap companies is abysmally low. Most of these companies fail within 3 years of their initial listing. When you look at the total return on investment for the average retail trader in the penny stock sector over a 5 year period, the number is usually deep in the red. It is essentially gambling, but with a rigged table where the dealer has a telescope looking at your cards. Think about that. If the best and brightest minds in finance struggle to identify the one in 1,000 penny stocks that actually succeeds, what chance does a retail investor have when they are getting their tips from a random chat room? You are not just fighting the company's bad financials. You are fighting the high transaction costs, the massive spreads, the dilution from toxic lenders, and the information asymmetry that favors the institutional players. It is a game designed to move wealth from the impatient to the informed. Once you see the market through this lens, the temptation to get rich quick starts to look more like a slow walk into a trap. So, there you have it. 3 real ways penny stocks systematically work against you: the pump and dump schemes, the constant share dilution, and the trap of illiquidity. Taken together, these factors explain why the vast majority of these stocks never see the light of day as profitable enterprises. Understanding this now gives you a massive advantage over the people still chasing the next big break in the penny market. You are no longer looking at potential. You are looking at the mechanics of failure. If you got value from this breakdown, share it with someone who needs to hear the truth about these markets and subscribe so you don't miss our next deep dive. We have something coming up next week that will change the way you look at your portfolio forever. Stay smart, stay patient, and keep building your real wealth.